welcome to the Sunday Supplement. This week's is called This Guy, and the reasons for that will become obvious if you don't already know them. So, for those who don't know, I like to start these with a quote. This week's is, "This guy has called me out a few times online and is now debating with me. Full debate will be uploaded with no edits. Bring it on." Fire emoji. So that was from some guy talking about me this week. Released Monday, 7 p.m. live on YouTube. If you don't know, just ask on the post on social media and someone will fill you in. And there's a bit more detail later on as well. So before I get started in earnest, I just want to tell you about the next property business workshop, Tuesday the 1st of April, where the topic is due diligence. This will be an entire day on due diligence, which is back after popular demand and much expanded on our last due diligence workshop in 2024, where we also covered two major topics in the same day. Fresh content and ideas, and tickets are live at bit.ly/PBW and then a number 6. I'm also collaborating with a couple of others to deliver a course on finding deals and sourcing. So due to time constraints, we only run a maximum of 2 of these per year, and it may indeed be the only one for 2025. Alongside Daniel Kennedy and Nick Bond, I'll be there. This is Birmingham based, talking through, no holds barred, the methods we use on a daily basis to find a healthy stream of property deals, whether you're looking to buy them for yourself, become a property trader, or earn an extra income stream through sourcing for others. We run these because, as per any of the training I get involved in, we're actually doing this with 90+% of our time and talking about it with 10% of our time. And that's the right ratio in my view to get real world and up-to-date information. It's great value, very intensive over the 3 days, and as always packed with content. And there's more details at propertymatchmaker.uk/sourcing-solved. So welcome to the supplement. I can't believe we're already at the last Sunday in January. That's 4 supplements down and 48 to go. It's been fast. This week started with many lamenting or celebrating the return of the Mac, the Donald, back in the White House. I prefer to stay unemotional because it's a waste of energy, and I just remember the old mantra, worry about what you can control at times like this. This week's deep dive goes into the Hamptons December 2024 Lettings Index, which was published this week. Their stuff's always of interest, and something that really caught my eye on LinkedIn as well this week, the community rent model. I really think this will be of interest to supplement listeners. I hope so, anyway. There's also a little room for some reflection on my big debate this week that the title this week refers to. Don't worry, no spoilers. I've been assured that the release in its entirety is scheduled for Monday the 27th of Jan. If you do invest the time in watching it, make sure to let me know what you think. In the real-time slot, Chris and the Property Market Stats Show rolls again. We get to ask that question that we love to know the answer to. What is currently happening in the UK property market? Listings. Yowza. Sure, things need some time to settle down in a new year, but 33,700 listings in week 2. That's 19% higher than the same week last year, 18% higher than 2017 to 19. So, as I was saying at the end of last year, there's still plenty of stock out there. And if you're selling stuff, you need to make sure it stands out in a market like this. Similarly, gross sales are well ahead of the pack. 23,800 last week. That's 48% higher than the start of 2024 and 8.7% higher than 2017 to 19. So you can see there, 2024 obviously started pretty slowly. But if you remember how negative things were at the end of 2023, perhaps that won't be a surprise. What about the fall throughs? Well, stuck at 25.4%, which is very, very close to the 7-year average, which is just under 1 in 4 sales falling through. 17,700 net sales is again 54% up on 2024 and 60% up on year-to-date 2017 to 19. So plenty of net sales. Chris's metrics, he likes to call them net sales excluding mansions. December's final sales figure per square foot, £339 compared to £322 in December 2023. This correlates with an R, that's the correlation coefficient for the mathmos out there, of 0.92 or 92%, which is extremely strong correlation indeed. And this is correlating with sales figures at the land registry 5 months hence. Right, so we've got the sales agreed figure, and then we've got 5 months later when they hit the land ridge. But 92% is an incredible correlation, makes it a very, very strong predictor. And that represents a 5.28% rise in house prices December 23 to December 24. Those of us who said 5% for 2024, yep, that's me, did a little backslapping congratulatory post on this week. A little throwback here too. Around the turn of 2020, the number was more like £270 a foot. Doesn't feel like that long ago, but from a price perspective, it certainly seems long enough. About a 23% rise since then, which feels as fair stab at a national average property market rise in the interim. Interestingly, not even kept pace with inflation, which I've discussed at some lengths several times. Now, Chris is worth a follow because he's more prolific than just this epic tome he releases weekly on the UK property market. He comes up with some great stats on a regular basis. Drop him a like, subscribe, follow, and all the rest of it. And also some kind words for his content creation. If you're in the industry and you want a ghostwriter, that's Chris's core business, so give him a shout. So we go from real time to macro, and it's that week of the month with the labour market report from the ONS and the usual qualifiers about how unreliable this data currently is. We have to discuss confidence. If you've seen the headlines, cratering would be fairly accurate in both consumer and business sectors. Then my darlings of the real-time info, the PMIs, and then we finish, as you know, with the gilts and swaps. So, the labour market. I often say the same thing, it seems. Unemployment gets all the headlines, but I prefer to look at employment. Now, there's a further qualifier this month, though. This is the November 2024 stats that have been released. Unemployment was expected by the forecasters to hit 4.4%, up from 4.3%. And it did. Wages were expected to hit 5.6%, upwards from 5.2%. They did. This is rare, 2 accurate forecasts in a row. Well, actually, there was a last-minute change to consensus, and consensus thought unemployment would instead hold at 4.3%. But when I looked a week before at the consensus, the expectation was indeed the number would hit 4.4%. So the last-minute change was wrong, but the initial thoughts were correct. Wages with or without bonus have converged, 5.6%, as one-off COVID bonuses have now worked their way all the way through the figures and are more than 12 months old, so they're not having a base effect anymore. In November 24, we also had a press release from the Resolution Foundation, who I've analysed in some detail before in the supplement. I'm not going to go into it in detail, but I will reproduce the key statements. With official data unable to provide an accurate picture of the labour market, the Foundation has created an alternative estimate of the employment rate, built up from HM revenue and customs payroll and self-employment data, as well as the latest ONS population data. Now, we know the official data is wonky because the ONS have said as much. They said it would be sorted by September 2024. I remember lamenting this about 10 months ago. And instead, of course, it still isn't fixed some months later, and there's no end in sight. So alternative measures are advised. Even the ONS themselves advise using a number of the real-time tools, such as payrolls and things like that, alongside its own figures and analysis at the moment to get a proper and clear picture. But this is no help to people like the Bank of England, who need to be able to rely on what the ONS or the OBR or whoever produces. So, then the punchline. The Foundation's analysis suggests there could be 930,000 more people in employment than the latest official figures suggest. And the current 16 to 64 employment rate could be around 76%, as it was before the pandemic, rather than its official rate of around 75%. So that's more in work than being stated and fewer inactive. That doesn't say how much lower unemployment would be. You'd have to assume a chunk of that. And then how much is about inactivity or not. Something has to give somewhere because this is an accounting identity. Theoretically, it all adds up to 100% somewhere. Now, the ResF wants to put pressure on the ONS to sort themselves out ASAP. And that's what they've stated in their press release. It's hard to disagree with that. So take the employment numbers with a pinch of salt, but those numbers were 74.8%, which leaves 21.6% inactive in the quarter September to November 24. This is down more than 0.5% from the post-pandemic high of 22.2. ResF would argue 75.8% or similar are employed, an extra 1%, which would take most of the found employed out of the inactivity pool, suggesting a ratio of about 80-20 inactive to unemployed that is being overstated currently by the ONS. But there'll be a report for a quieter week that goes into detail, I'm sure. Real terms pay growth was 2.5% when adjusted for CPIH, which remember is CPI including the housing element, and is higher than CPI currently by about 1%. So that's a great rate of real wage growth currently. It's also an unsustainable one in an economy that isn't growing. But that's not a month-to-month issue, more of a quarter-to-quarter or year-to-year issue. It's far from the only unsustainable pattern in our economy at this time. 51,000 days were also lost to labour disputes across the UK. Always sickening, whatever that number is. Less than half of what it was, though, for many months during the post-COVID industrial disputes, of course. And job vacancies were down again. This is now a 2.5-year trend. And there were only 16,000 more vacancies than there were before the pandemic. Vacancies were down 24,000 in the final quarter of 2024. So another quarter like that, and there'll be fewer vacancies than there were before the pandemic. And the labour market really will start to look a bit looser. As always, though, where does the trend end? It doesn't at the moment, with Rachel Reeves' budget still looming like the sword of Damocles over many businesses come April the 1st. There are now 1.9 unemployed people per vacancy, and it was nearly 1-to-1, that ratio at one point. In the US at one point, there was only half a person per job vacancy at one point towards the end of the pandemic. So the drift is real. I've mooted a possible unemployment rate of 5% this year. But if Resolution Foundation are correct and the ONS sort the data out, I'm forecasting that based on the current ONS number. So I'm talking about a slippage of about 0.75% in unemployment from where we started the year. So my 5% could be wrong, but the difference could be right if the Resolution Foundation are correct and if we find out the real number by the end of the year. No one's holding their breath, right? Will it be sorted by the end of 2025? Side bets at your leisure, folks, but remember the maximum bet is 50p among friends. So what about confidence? Okay, that's the end of that section. Now, in seriousness, there are 3 measures that I often discuss and highlight. GfK's excellent consumer confidence survey is highly regarded. CBI's business optimism and industrial trend indices are also important data releases, but the GfK number trumps them for importance. The economic consensus is often wrong on the consumer confidence index, and this month was no different. The expectation was a very small drop from -17 to -18. So if you're not familiar with this index, I should say it's always negative. Pretty much very, very rarely does the consumer confidence index print above the waterline. Is that just because in the UK we're quite pessimistic as a nation? Possibly. But instead of it dropping from -17 to -18, it dropped to -22, which is a bit of a whomp, right? Lower than any point in 2024, which, as I said earlier on, started fairly miserably from a confidence point of view in the property market. But the Insights Director, in their overview, highlights a few things. A 5-point drop in the overall score. The views on the UK economy in the past 12 months have gone down significantly, worse than January 2024's reading, which, bear in mind, was thinking about 2023, which was a ropey year, and we just had 2 quarters in a row of negative growth. Although we didn't know about it yet, I suppose, because those figures do take a couple of months to come through. The general economy over the next 12 months, the expectation of that went down 8 points to a number far lower than 12 months ago. We were -21 in Jan 24, we're -34 in Jan 25, down from -26 in November and December. This is a serious decline. The saving index also shot up 9 points. These are really seriously volatile swings in this index compared to usual, and that's highlighted as an unwelcome sharp increase. Another sign that people see dark days ahead and are therefore thinking of putting money aside for safety. This is the self-fulfilling prophecy, because remember, economics is simple. You either save it, meaning you get income tax if you get any interest returns, if you get anything meaningful, or you spend it, meaning VAT, frictional taxes, profits that are taxed, jobs, etc., etc., etc. The circular flow of income, as it's known. So ever since I've reported on the GfK survey, which is a couple of years now, as I recall, this is the worst change I can remember in 1 month. I was not regularly reporting on it back in, say, October 2022. I know, here we go, as usual, the lettuce off to the salad shredder, but it is safe to say this is the biggest decay since then. I wouldn't expect January retail figures to look particularly good at this rate. I do feel obligated to note the survey period here though, January the 2nd to January the 16th. The gilt wobble peak was 13-14 and the climb started Jan the 6th, which is the first real day of work of 2025 for many. Therefore, most of that period was characterised by those negative headlines, including highest borrowing costs since 1998, etc, etc. So let's not lose the dressing room completely. If the gilt markets keep being stable and there's some good economic news, and that might just be no news is good news, then February may start a slow process of repair. Babies and bathwater and all that. So, the CBI industrial trends. They focus on manufacturing. Sentiment fell at the fastest pace for over 2 years. Output volumes fell, but less sharply than in December. Further falls in output are expected over the next 3 months, and that expectation is the fastest pace of falls in orders since the pandemic. Expectations for growth in costs are at their highest for over 2 years. Investment intentions have deteriorated markedly. Lower spends on building, plant, innovation and training. Innovation in product and process had its worst print on this survey since 2009. Uncertainty of demand, inadequate net returns and no access to internal finance were all cited. Sentiment printed -47 from -24 in October. The survey, the best way for manufacturers to communicate their intentions to the government, organised by the CBI, tells a very clear story. We aren't bluffing here, folks. This is for real. The PMIs tell us whether it's true or not. In fairness, they have already done so in the past 3 months by dropping well below 50 as the print for the manufacturing sector. Let's pretend we're in the Treasury. How can we make the best fist of it? Well, I suppose we have to say, never mind Tarquin, no one worries about manufacturing anymore. Services will sort us out. That's all I can hear because this sure seems to me from a policy perspective, or lack of it, that this is all falling on deaf ears. Might as well become farmers. Oh no, don't forget the farmer harmer is at the top of the tree. Talking of the PMIs though, let's see the fibre of that fabric. Some good news, you hope. Well, it isn't as miserable as all of what's gone before. Let's be as non-partisan as possible. Businesses are going to moan from the high heavens about what has happened in the budget and since. They have accepted in majority their margins will be lower. No one is ever happy about that. I often make the point about surveys about intentions versus measures of action, and the latter are vastly more valuable. The PMIs are about action because they're about what the purchasing managers have done, but in real time. Whereas a consumer doesn't just wait until the next survey before they change their mind about confidence and things like that. So, what has January's action been? These are the flash numbers, the early estimates, but not often revised significantly unless something massive happens in the last week or so of the month. S&P, who collate and publish the PMIs, which are highly respected and again correlate very strongly with GDP growth a few months in advance, hence their usefulness, also have a consumer confidence index. It's never deposed GfK as the top gun, but it tells a very, very similar story to the GfK one, with some more details about debt and sentiment about jobs. Many of their metrics tell a story of worst for 10 to 18 months. Let me leave it there. But their flash PMIs are a shade better. Not for manufacturing, pretty much completely congruent with the above. But delightfully, the main headline was, business activity growth edges up in January, but job cuts continue as cost inflation hits 20-month high. Now, sickeningly, that's the most positive headline for months in the PMIs, other than in construction. But on the bright side, the composite index printed 50.9. That's a 3-month high. Services at 51.2, another 3-month high. Manufacturing's also at a 3-month high, although it printed 48.2, which is still going backwards, remember, because it's below 50. This data went on a little longer in terms of its collection period. This was collected until the 22nd of January, so it might be a little bit more reflective than a GfK index for January because of what went on in the news. Services lumber on as the economy licks its wounds. That might be a better headline. This is the resilience that might lead to 1% growth this year, as I've mentioned, with my emphatic scorn poured on the 2% OBR forecast, or the IMF's 1.8, or pick a forecaster. The 50.9 composite print sits well below the long-run average of 53.6, bear in mind, to put things into context. 25% of the way above the watermark compared to the average, or 1/4 of long-run growth. On January's flash number, even my 1% looks hopeful, which is why I've elected for a range of 0.5% to 1% GDP growth this year. Chris Williamson, the chief business economist at S&P Global Market Intelligence, is one of my favourite commentators as he cuts to the quick effectively. Here's a highlight of his thoughts. Inflation pressures reignited, pointing to stagflation alongside job cuts and concerns about business prospects. The economy is broadly flatlining. Risks as to the downside, optimism is falling. Sharp job cutting, and the Bank of England have a tough job, according to Chris. Rate cutting is needed to stimulate growth, but rising price pressures indicate that the inflation genie is by no means back in its bottle. It did make me reflect that if only someone had been talking about that for the past 4 years, that this would be the case. That might have been useful, but I can't think who that might be, apart from me. So, it's a nice turn of phrase from Chris about a poor quality situation. Right, if that lot hasn't cheered you up, and remember, get your kicks elsewhere. This is the supplement. It's designed to tell the truth without agenda or pause. Then this won't either. But we need to keep our weekly monitoring of the gilts and swaps market alive to get an idea of mortgage rates and our future as borrowers. We opened the week on the 5-year gilt at 4.378% yield and closed at 4.353. I did say I love boring weeks where the yield decays by 0.03%, and I nearly got my wish as we lost 0.025% from the 5-year gilt yields. The market tested below 4.3 early on Friday, and then it rebounded to finish about 4.35, and that trading range for the whole week was 4.43 to 4.296. That's pretty tight, 13 bips, and the interpretation would be the confidence figures are not enough alone to force rates lower or mean more rate cuts. The PMIs were received as economy's doing okay in the circumstances, according to the market. We're not near a recession just yet. The 5-year swaps closed Thursday at 3.993. Hooray! Meaning that 6% is once again our best guess cost of 5-year limited company mortgage debt, no fee. The gilt closed Thursday with a yield very close to Friday's close, so that looks about right, and the right side of the psychological 4% barrier as well. Not bad for a month that started with people calling for Bank of England interventions and the Chancellor's resignation. PTSD, that's post-trust stress disorder, by the way, still seems rife in the media and financial press and the bond markets, for that matter. So, the right side of 4% and a down week in the bond markets. Let's take it and let's get deep diving. Firstly, Hamptons. As so often, they produced a decent quality report, but they really didn't control the narrative from this one effectively, in my opinion. What did the press want? Well, blood, as usual, from the landlords. Hamptons also clickbaited the whole thing by giving absolute figures, of course, just like house prices higher than ever, rather than my more favoured, eggs are more expensive than ever, etc, etc. Under 45s now pay 56.2 billion in rent. Good? Bad? Indifferent? Well, context, as always, is everything. Here's the real story from their report. Unusually, in the actual report, they lead with it themselves. For most of the past decade, the growth in the private rental sector has been from older renters who didn't purchase a home in their 20s or 30s. From the English Housing Survey, they draw the conclusion that renters aged 45 plus went from 1.43 million to 1.77 million, or grew by 24%. Now, with no context on the actual underlying population growth, which out of interest I looked up during that time, was about 6.75%. So still, even if we normalise that figure for population growth, it would still be growth nearly 4 times more than the wider population grew. So still very significant statistically. But I do like to try and do a complete job, as you may know by now. The number of households under 45 renting fell by 1%. So again, adjust for population, and they fell by much more than that. And that's over that same time period. However, the entire expansion in the sector between 22-23 and 23-24, which was far smaller than the expansion needed, please note, for the extra population growth, has been fueled by under 45s, and Hamptons choose to blame the withdrawal of Help to Buy for this. They also blame the withdrawal of Help to Buy for the extra rent paid, rather than the rent increases or the interest rate increase, which would be much more realistic reason for the huge rent increases that there have been. Now, They say rent's up 3.5 billion in that segment to 56.2 billion. That's an increase of 6.6%. Now, that's lower than the rent increase rates reported by the ONS for the year, for example. But again, no context is given to this. The share of rent paid going up makes a different point, however. Could the point instead be that the vast majority of migrants are under 45 and tend to rent property, as I've talked about in the past? And the year in question saw a very large increase in net migration. I think it's a bit silly to try and lay the blame squarely at the door of the withdrawal of Help to Buy, but of course, perhaps Hamptons are just talking their own book, and who can blame them? Why are they doing research after all? They're trying to achieve something, aren't they? And in that one, they're trying to achieve influencing government policy. But the equivalence that they draw is so weak, I just don't see how that will help, to be honest with you. But the remainder of the points in the report don't really correlate with what we've seen in real time. Slower rental growth, a limited rise in the number of tenants. Well, perhaps that is true because the properties weren't there to house them, I suppose. And rents only went up to 85.4 billion total, which is up 2.8 billion year on year. Now remember, we're only talking about the year to March 2024 here, because that's how far behind the English Housing Survey is. That sees total rent paid only up 3.4%, which I think is highly unlikely, and the ONS and Dataloft would certainly disagree. But it's possible, of course, because ultimately rent could go up by that total percentage, but it could be that the sale of PRS stock is much more commonplace in the south, where rents are higher. Yeah, and it could be that, 1 and 2 property landlords that have moved out of homes they used to own are particularly low yielding, and high interest rates put pressure much more on more expensive properties because they have bigger mortgages and lower yields as a general rule. So it is possible for all this to coexist, but again, there's no real detail given around that in Hamptons. It just looks a bit strange and stark when it sees rent up 3.4% and it's not mentioned with any context. Now, Hamptons don't disclose their own source data, but it does strike me a bit as a question mark over their effectiveness or accuracy, potentially. In the same report, next paragraph, they quote rental growth on their own figures as at December, from December 23 to 24, at 10.2%. Awkward. Still, Hamptons now have average GB rents at 1,367 per month. That's up 2% year on year, which is around down there with the home let figures, but about half of the Rightmove and Zoopla figures for rents. And remember, they're always talking about new rents, because that's the only data that they have, not as comprehensive as Dataloft and the ONS. So, I feel more underwhelmed by this report than any of the Hampton ones I've ever analysed before. But again, I'm not going to throw the baby out with the bathwater on them. I'll give them a fair crack of the whip in the future. There's one more direct quote from the report which I thought I would share, although it's a small sample. While new purchases by landlords held up in December, early signs in January suggest the new 5% stamp duty surcharge is starting to bite, which could fuel more rental growth in the coming months. Now, the basics of economics suggest fewer rentals or fewer second homes generally will be acquired than they otherwise would have been at 3% additional stamp. We're certainly offering lower as a group, that much is for sure, and just by definition, if you're going to offer lower, you're going to do fewer deals, with all else being equal. Okay, enough of Hamptons and onto the community rent model. Now, this is the brainchild of Darren Rodwell, 10 years as leader of Barking and Dagenham Council. A Labour councillor, don't hold that against him as a first point of order, please. Entrepreneurial at school in a way that many a good story is told, costing the school tuck shop by flogging his own wares out of his bag. I like him already. More impressive is delivering the most social housing starts in London. He truly understands the problem, and that in itself is a wonderful thing to see. He talks of public sector versus private ingenuity. Again, the only way to solve problems at the governmental level. His community rent model sees 6 levels of rent, from council equivalent rent or 50% of market rent inside the LHA to 65% of market, which is the London Mayor's living rent, then 80% of the market rent. Now remember, this is the intermediate or the definition of affordable rent. Remember, 80% of market. Then 100% of market. Then shared ownership, or the right to invest, as he prefers to call it. So you've got this wonderful sort of six-tier system. So 3 times as good as 2-tier care. Sorry, couldn't resist, Darren. Sorry. But yeah, it does sound like a nice blended approach that has levels of complexity, but definitely sounds doable and achievable. So you have basically a stepped rent depending on the household's income. So let's try and pull it apart to start with, because we need a bit of scrutiny. So firstly, you'd think the cliff edges might well act as a disincentive. Of course, if you earn over £100,000 a year, that also has disincentives, and some people react to those disincentives by going part-time. It isn't a reason to change things necessarily, although phasing things in might be a better option than a stark hike. That's what happens with child benefit, for example, these days, phased in between 60 and 80k of household, or phased out, more accurately, clawed back between 60 and 80k. It's a slow and gradual clawback rather than a sudden, oh right, we're going from 65% of rent to 80% of rent if I do this. If the choice is stark and it leaves you worse off as a household, what choice are you going to have as someone who's trying to break your way through the glass ceiling? So the transition between rents in Darren's model unfortunately isn't clear in what's been made available online. And Darren, if you do listen to this, I'd love you to publish a paper or even come and talk to me at length on it. Love us to do a Zoom call and broadcast it on the channel. I think it would be fabulous. So credentials, other than the most social housing starts, which is impressive anyway, the delivery of 20% of London's social affordable housing since lockdown in one borough, like Barking and Dagenham. Remember, there are 33 or 32 plus the City of London. So that's some serious outperformance there. 3% delivers 20, seriously impressive. So Darren stepped down in 2024 from Barking and Dagenham from leading the council, and was then torpedoed from being a parliamentary candidate, which seems to me like an utter tragedy. And there's many ways you could go with thoughts around that. Someone who actively knew and framed the problem correctly and was delivering. Wasn't he needed at a national scale? He talks data. That's why I like him, right? A recent LinkedIn post talks of the data on the Barking and Dagenham Council waiting list. Families on the list earning between £20,000 and £60,000. Traditional council stock is for families earning around £18,000. So that created a gap, of course. Earning more but can't afford private rent, the missing middle. His approach caps rents at 40% of household income, well above what the ONS deem affordable, of course. But the metric that many agents use, and certainly in London, over 40% is absolutely commonplace. Long-term public and private investment. Mixed incomes, key workers finding homes to match their needs and aspirations. Correlating them to income in socially held stock is an excellent idea. Affordable, flexible, inclusive, removing stigma, which is huge, and working for all. Opportunity, resilience, and fairness. Now, you can hear the Labour mantra in some of that, but look at the benefits of mixing in some entrepreneurial spirit and some private-public cooperation. The results that Darren achieved, no doubt aided by a great team, are really not to be sniffed at, and it finds me somewhere between disappointed and appalled that Darren was not pushed forward with vim and vigour at the softest Labour Party election of nearly all time in July 2024. Darren, I'm delighted to say, already subscribes to the supplement on LinkedIn. That's a pure fluke. I was going to write about this anyway, Darren. But if you do read this, as I've said, or if you listen to this, I'd love to have a chat with you and broadcast it to people on my YouTube and help to get the message out there a little more. So, a workable, flexible, modern approach to seriously improving communities, people's lives, and the dependency, or lack thereof, on the state, and helping people and councils build more desperately needed social homes. Labour at the parliamentary level, I hope you're listening to Darren, even though he didn't make the cut or his face didn't fit or whatever the reasoning was. So, as we draw towards a close, folks, just a few bits of reflection around what I invested about 4 hours in this week, debating Samuel Leeds. Bear in mind that includes travel time, folks, don't worry, it's not a feature-length film. I created a situation with probably my biggest bait post ever on social media before Christmas, when I saw Samuel was verbally offering out all comers. I like a challenge, so I stepped up and wrote a nice fat verbal check saying I was going to take him apart or similar. Strong chat. Samuel, if you don't know, has form for punching people in the face. Don't worry, it is the Marquis of Queensberry rules, of course. He's had a few boxing matches, so I thought I'd better watch my step. But this section is probably best done in the form of an FAQ, I think. First of all, why did I do it? Because life has taught me, if you want to try and do something or change something, you need to step up and try and do it. I thought he might listen and reflect, and I thought some of his followers might too. And that, for me, was worth it. What exactly did we debate? Well, that's under embargo at the moment, but you'll find out on Monday, 27th, YouTube on Samuel's channel, and I'll also be posting it on Propenomix later down the line as well. Did I win? Well, that's an interesting one. I think from every debate I've ever listened to, that's probably in the eye of the beholder. I sure had some interesting private messages before, during and after, and I don't suppose those are going to stop particularly quickly. Did I change my mind about Samuel? That's a good question that a couple of people have asked now. In honesty, and Samuel has admitted he didn't know that much about me beforehand, although he did have a data capture and a phone interview carried out on his behalf. I realised I didn't really know that much about him beforehand, and as time went on, I did feel I could have been better prepared. I like learning, as regular listeners here will attest to. Did I get what I wanted out of it? Now listen, there were boundaries. There has to be, unless you go full Joe Rogan. I'm not sure if Samuel is planning to do that in the recent future, although one of his boxing scalps, Rob Moore, is already having a go at that. I had a go. I did my best. That's my mantra, really. Would I do it again? Absolutely. Did I make Samuel think? I hope so. He will say, I'm sure, well, perhaps he'll even listen to this. Who knows? Did I upset a few people by doing it? It seems so. This perhaps leads me to believe that it probably was the right thing to do, because you don't upset a few, you haven't done anything worthwhile. The caravan will roll on, folks, don't worry. I hope you do give it a watch and also give me your honest feedback. I'll enjoy reading it all and I'll reply to whatever I can within reason. So as I do draw to a close for the week, I'm just going to take the opportunity once again to remind you of the sourcing course I'm going to be delivering 21 to 23 March alongside Daniel Kennedy and Nick Bond. All sausage, very little sizzle, real-time examples of how we find deals on a daily and weekly basis, an experience of many tens of thousands of deals analysed to lead to over 1,000 deals being done between all of us. There's a reason why we call it Sourcing Solved, because that's what we're aiming to do. So the information and tickets at propertymatchmaker.uk/sourcing-solved. And remember to save that date on the 1st of April for the next Property Business Workshop 2. Due diligence, the most comprehensive day on DD that will ever have been delivered in the property space. And that's a guarantee from me. So as always, please remember to keep calm, always listen to the supplement and carry on. Well, all this noise around chancellors, bond yields, TikTok being bought by Mr. Beast, I hope, and goodness knows what else roars around us. Until next week, folks, thank you.